everyone, and welcome to our webinar on investment strategies for 2021, organized by Majmudar and Partners. Just a brief introduction about the firm. Majmudar and Partners is a leading law firm in India. It is one of the oldest and most reputed firms in India. In total, we are close to 100 lawyers across 6 offices and serve clients nationally and internationally, with about 80% of our work being international. Almost 75% of our international work originates from the US, and hence it continues to be an important market for the firm. We are a full-service law firm, and our core practice areas are corporate M&A, competition, private equity and venture capital, tax, banking and finance, dispute resolution, employment, projects and energy, and TMT. We are also one of the few Indian law firms to have an industry focus. It is a pleasure to host you all today. In our webinar, we will be discussing the key legal considerations for M&A transactions and deal making in India, with a specific focus on 2021. Introducing our speakers for the day. First up, we have Mr. Rukshad Davar, partner and head of the M&A practice at Majmudar and Partners. Rukshad has over 20 years of experience in corporate M&A, competition and tax matters. He regularly advises his clients on complex domestic and cross-border mergers, acquisitions, corporate restructurings, joint ventures, private equity, and strategic investments. As a lawyer and chartered accountant, Rukshad also assists clients on tax matters, including treaty issues. Prior to Majmudar, Rukshad was with the Indian affiliate of Jones Day, a leading US law firm. We also have with us Mr. Ravi Raghavan, Tax Counsel at Majmudar and Partners. Ravi brings with him over 25 years of experience in corporate tax advisory work, business reorganizations, tax litigation services, and international tax issues. Before I hand over the floor to Rukshad to start the discussions, I would like to inform the audience that our speakers will be glad to take up a few questions at the end of the presentation. You can send us your questions in the chat box available on this platform throughout the presentation. Over to you, Rukshad.
Thank you, Kritika. Thank you. Thank you for the introduction, Kritika, and welcome everybody for this webinar. And essentially the theme and the focus of this webinar is to discuss on investment strategies for this year. We would take you through certain regulatory issues, regulatory nuances, as well as certain cultural issues that you need to keep in mind. Also, we will be discussing certain key statistics as well as a case study that we have formulated. And thereafter, my colleague Ravi will be taking the tax considerations in relation to investment strategies for this presentation. So I will start off with the presentation. So despite the pandemic, India as a country has seen a steady inflow of FDI over the past year. And in fact, the FDI inflow in 2020 has been higher than what it has been in the previous year. We have, as a country, seen a significant amount of investments and a steady uptick in FDI investments on a year-on-year basis ever since India has opened up its norms and allowed foreign participation in India. And more especially since 2013 onwards, we've seen a huge spate of FDI investments coming into India across a smattering of sectors. In India, I mean, certain destinations and certain cities continue to be favorite spots for investors to do business in India.
I think we've lost Rukshad, so just give him a moment to reconnect.
Hi, apologies for dropping out. I mean, I think there was some technical issue. So where I was is that FDI is attracted and investors are investing in Maharashtra, Karnataka, Gujarat. Those are the top three states attracting FDI. However, we have seen recent investments in the automotive industry going into people are going into Chennai as well. And a lot of the tech investments are happening out of Hyderabad as well, besides these three states. So the computer, software and hardware sector, the services sector continue to attract a higher FDI. But we've seen also the pharma, healthcare, life sciences space, as well as industrials and manufacturing attract a lot of FDI over the past couple of years. Also, the outsourcing story and the captive units in India and investment of foreign entities into having captives in India continues to be an evergreen story in India. Uh, the top investing country undoubtedly is the United States of America, and it continues to invest a lot of monies into India. And those monies are coming directly from the US, as well as investments are routed through intermediate jurisdictions. We used to see a lot of favor towards Mauritius and Singapore being used as intermediate jurisdictions for routing investments into India. However, of late, we have been seeing a lot of investments happening through the Netherlands, which offers a very good tax advantage as well. Next slide, please. So this is in this slide, I would like to really discuss Press Note 3 of 2020, which has been introduced in April of 2020, which really, foreign investors need to keep in mind whilst investing in India. Essentially, this press note talks about requirement of a prior approval from the government of India for any sector, for any investment, if that investment is coming from any land bordering country of India. So essentially, because of the geopolitical tensions with China that India has and had earlier, this press note was introduced. And although it does seem to target and does target investments from China, but also investments from Hong Kong and Taiwan also would require prior approval from the Indian government prior to investing. Now, it's not only fresh and new investments that would be covered and which would require sanction from the government of India, but also uh, further capitalization of existing investments, even if the earlier investment was under the automatic route, but now if the investment is, there's going to be a further capitalization, that would also need to pass muster of the Indian government and would require prior approval. What this press note has now entailed is that even multi-jurisdictional transactions would require prior approval if any of the investors are from these land bordering countries. The worrisome part about this press note is that there is no de minimis threshold or no criteria which has been specified by the government, and it continues to be so. So as a result of which, there is a lot of calculated decisions that need to be taken whilst really advising clients who are investing from these land bordering countries. So there has been a significant ambiguity, as a result of which, investments have from these land bordering countries have dipped in the previous year with the introduction of this press note. So it is hopeful that in the coming months, the government would throw some light on some threshold requirements or approve certain transactions which have been with the government for the past couple of months to enable people to get clarity as to how to move around this issue about Press Note 3 of 2020. Also, it's important whilst investing in India is to understand certain cultural issues and certain nuances that you need to keep in mind whilst doing business in India and whilst negotiating with Indian counterparts. Of course, there are a lot of now businesses which are professionally run, professionally managed, but what we have seen and what our experience throws up is that often foreign investors find it difficult to navigate through family-owned businesses and businesses which are traditional family-run businesses where there's a lot of hierarchy. So a key point that needs to be kept in mind is that more often than not, where we've seen that although there is a professional setup and management in these companies, but we've seen in a lot many instances that ultimately the decision making is controlled by the family and the family office. So in that case, I mean, when y'all are investing in India, when people are investing, when foreign investors are looking to invest in India, please make sure that all the decisions from time to time are vetted and are passed on by people whom you are interacting with within that organization so that those are concurred by the top level management, because more often than in certain instances we've seen that the decision on various items which have been taken in course of negotiations are again are redundant because the family office and the family owners think otherwise. So in India, meetings tend to be more informal than what they are in the western part of the world. Timelines are pretty indicative. So when you, I mean, on a lighter note, when people say yes, yes, we will get back to you with a document, we expect some delay on timelines. You know, you cannot expect everything in a record-breaking turnaround time. So that's another thing that needs to be kept in mind. What we have seen is through due diligences that there is a significant degree of non-compliance or low compliance on corporate records and employment records, which needs to be really investigated in the course of due diligence, because of course these are all can be amended as conditions precedent or conditions subsequent as time permits, and those need to be rectified. When a foreign investor is keen to buy out the stake of the Indian partner, uh, there are certain points that need to be kept in mind that often the family-owned businesses would expect a premium. In addition, I mean, a higher price than the valuation. They would, in certain instances, what we have seen is that they also expect to have certain key managerial positions, and that would also help foreign investors to a large extent in terms of transitioning into the business. And another important point is that if at all it is known that there is a lack of interest or a lack of successor in the family office, that would be a key point to drive that buyout. Likewise, for exiting, uh, Indian guys, the people who are wanting to buy out the stake would expect some sort of discount on the valuation. So be prepared to take a little bit of a haircut on the ROI and the exit valuation. Also, what we have been advising is that non-residents should preferably sell the stake to another non-resident in order to avoid some certain valuation requirements or and certain there are a little less of regulatory implications if you have a non-resident buyer as compared to a resident buyer in place. But that's not no hard fast rule, you know. I mean, of course, you can have transactions with residents as well, but this is another point that needs to be kept in mind. So certain uh, investment strategies that are regularly adopted by investors in India are either by way of doing investments by way of asset purchases or slump sales or a share purchase. Essentially, asset purchase means cherry picking assets and liabilities as are desired by the investor. Slump sale is an India specific concept which really talks about a movement or a transfer of an undertaking or a business on a continuous basis, on a slump sale basis, and on a lump sum consideration without individual values being assigned to different components of the business. Now, for stamp duty purposes, that's a duty that we have to pay on different elements of the transfer of the business. So for that purpose, the Indian tax law has allowed values to be assigned for individual assets proposed to be transferred through the slump sale. Now, in case of a share purchase, I mean, it's universally known that the entire entity would move consequent to the purchase of shares. Important point that needs to be borne in mind is the stamp duty implication for considering which mode and which investment strategy to adopt, whether to go in for an asset purchase or a slump sale or a share purchase transaction. So in case of an asset purchase, you are required to pay stamp duty on each and every element of the business and assets that are transferred. In a slump sale, on a business transfer, you do not it would depend on the values attributed to each asset, and you would need to pay stamp duty. Share purchase agreement, you would need to pay stamp duty on the transfer of shares, which is very low. So people do take this mode into consideration for having the stamp duty benefit. Now, as far another consideration that needs to be kept in mind whilst really choosing the investment strategy is on the GST implication, that's the goods and service tax implication. So GST is attracted in case of an asset purchase. It's not applicable for a slump sale, that's a business transfer or a share purchase. Another important point is insulation of liability and liability moving on to the successor entity. In case of an asset purchase, you can definitely ring fence through documentation the liability. So predecessor risk and liabilities can be avoided to be moved on to the successor entity. Likewise, even in a slump sale through robust documentation, you can insulate all the misdoings and the wrongdoings of the predecessor entity and liability implications from moving on to the successor entity. And in case of a share purchase, of course, it's known that the entire entity moves. Besides, of course, carve outs on indemnity, reps, and warranties, you cannot really ring fence the predecessor liability from moving on to the successor entity. So certain key investment considerations that need to be kept in mind whilst doing business in India is that there has been a rule that has been on the rule book and in the FDI policy since the past couple of years, which is called the 1825 rule, which essentially limits the indemnities that can be forthcoming to the investor, as well as deferment of purchase consideration by the foreign investor. So what this rule talks about is that when there is a transaction between a resident and a non-resident, the indemnity is capped to 25% of the purchase consideration, and it cannot exceed beyond 18 months. And even the deferment of consideration cannot exceed 25% of the total purchase price, and it cannot be deferred for more than 18 months. We have, of course, in the next slide, I will be discussing certain workarounds on this rule. From a contract perspective, you need to bear in mind that non-solicit clauses are enforceable during the term of the contract and even post termination. On the flip side, non-compete clauses are enforceable only during the term of the contract, and they are not enforceable post termination. So that needs to be kept in mind. Of course, non-compete clauses can be enforced through an employment arrangement also during the term of the contract. Confidentiality provisions, although India has not got a law specifically on safeguarding confidentiality of information, Indian courts have consistently upheld and granted injunctions to protect the confidentiality of information, and that has comforted foreign investors to a large extent whilst doing business in India. Also, another important point that needs to be kept in mind is about damages. So when you are seeking damages by way of indemnity or contractually, you need to keep in mind that only actual and proven damages are awarded by courts. Consequential damages are not awarded. Liquidated damages are also awarded by courts, provided it's in the contract. You can also limit liability and have a limitation on liability clauses in the contract. However, courts are not going to recognize limitation on liability and clauses to that effect if there has been a fundamental breach of contract or if there is something that opposes public policy. So a quick case study that we have really put up on this slide that will just throw up some few interesting points is that here we have set out that the foreign investor, assuming that they have a Indian subsidiary, which is an operating first level Indian subsidiary in India, they have 100% investment in the Indian subsidiary, and that Indian subsidiary has an 80% participation in the Indian joint venture entity. And the Indian joint venture partner has a 20% participation. Another nuance can be another thing is where the foreign investor directly holds 80% from the host investing country and not through their Indian subsidiary, and assuming they don't have the Indian subsidiary. And the Indian joint venture partner would hold a 20% stake in the Indian joint venture company. Now, certain key points that you need to keep in mind is that a press note 3 analysis has to be done. You know, you need to often you need to consult the authorized dealer bank because they are going to take certain declarations as in respect of beneficial ownership, whether those whether that ownership is controlled or held by investors from land bordering countries. So that needs to be kept in mind. The 1825 rule would apply if the foreign investor is directly investing from the host country into the joint venture company. However, this 1825 rule can be obviated and you can work around that, and thereby you can have no limits on indemnities in terms of the rule will not apply. So an entire 100% indemnity can be forthcoming, or you can defer the whatever consideration as commercially agreed, and escrow also whatever you need to have as commercially agreed between the parties if you route your investments through an Indian subsidiary. But the key is that that Indian subsidiary has to be an operating entity. Now, typically in the pharma sector that we have discussed out here, you will need to take prior approval of the Department of Pharmaceuticals if the investment is more than 74%. And likewise, you will need to see if you are falling in other sectors, you will need to see if there are any caps on foreign investment, as well as certain sector conditionalities which are specified under the FEMA rules and under the FDI policy. Another important point is that the JV agreement needs to be comprehensive and robust so that you mitigate to a large extent any disputes and any issues later on that arises if there is some animosity with the Indian joint venture partner. If you are getting into a dispute with the Indian joint venture partner, exit options should be clearly specified. And also another important point that I want to touch upon is on the control aspect. So in certain sectors where foreign investment is capped to a particular extent, like say in insurance, like a 49%, you cannot give disproportionate rights to the foreign investor in excess of that what you are providing to the Indian investor. So in certain instances, like earlier in the Jet Etihad matter, we have seen the Foreign Investment Promotion Board really scrutinizing agreements and striking off certain clauses which granted foreign investors certain rights which were not available to even Indian investors, despite the foreign investor holding a minority investment in the entity. So with that, I would hand it over to Ravi for the tax considerations in relation to investment into India.
Well, thank you very much, Rukshad. Very useful comments. And thank you to all the participants. Thank you for your time. We deeply appreciate that. I'll take you through a few tax considerations in India. The first is that, in the last couple of years, we have seen the corporate tax being reduced in a phased manner. It still remains 30, but it has been reduced by bringing it down to 27, 25, 22, and then now to 15. So manufacturing companies that are incorporated after October 1, 2019 will be taxed at 15%. And companies that are in the manufacturing sector or in the services sector or any other sector other than manufacturing can still opt for a 22% reduced rate of tax. But this reduction in corporate tax rate comes with certain conditions attached to it. What the tax law says is that if you want 15% or 22%, then you cannot claim certain deductions or incentives that are otherwise available to a company that is being taxed at the rate of 30%. What are these deductions? The first one is the export benefit deduction. Second, investment allowance deduction, accelerated depreciation. If you set up certain companies in certain backward areas or identified areas by the government, then any investments that you make in plant and machinery will not be allowed as a deduction. And any carry forward of loss in relation to such deductions will also not be available. So apparently the 15% and the 20% looks very good on fine print, but the devil lies in the detail. Limited liability partnerships, on the other hand, are taxed at 31%, or it may go up to 34.94%. That includes surcharge and education cess. So the question that comes, to the minds of the investor, that what do I set up in India? Do I set up a private company or do I set up a limited liability partnership? One would say that looking at the tax rates, the company option seems to be extremely workable, but to be honest with you, it is not. You know why? We have to look at dividend taxation for a few seconds. Prior to April 1, 2020, Indian companies that were distributing dividends to its shareholders, they used to deduct tax at the rate of 20.3%. That deduction was not considered to be an income in the hands of the shareholders. So a tax credit could not be obtained by the shareholders in the home country. So effectively, you had a tax rate of 30% for Indian company plus a 20% dividend distribution tax, which made the return on investments, the tax amount went up to 50%. Whereas in the case of a limited liability partnership, there was no dividend distribution tax, and therefore the LLP structure was considered to be optimal. But now with this change, dividend distribution tax will no more apply. That is, the Indian company will not deduct, but the dividends, when they are distributed to the shareholders will pay income tax on the dividends. The Indian company will withhold a 20% tax prior to paying the dividends, of course. But under the India-US treaty, to take as an example, the dividend rate is 15%. So the key difference in establishing an Indian company or an LLP, you have to consider two important factors. One, whether I can forego the specified deductions, and two, can I claim a tax credit in the US of the 15% that has been deducted in India. Article 24 of major treaties provides for a tax credit facility, but the problem is that it says that this is subject to the domestic law of the foreign country. So therefore, in our view, the recommendation would be we need to sit down with our financial advisors. We need to check if we are going to get a tax credit of the dividend tax in India, and if we can forego the deductions. So assume that you're able to forego the deductions and you don't get a tax credit in the US. That means, although you're having a 25% tax rate, what I mentioned 22 is actually 25.17 because you have to add 10% surcharge and 4% education cess, which makes the 22% 25.17. So net 25.17 plus 15%, you have a 40% leakage. Whereas in the case of an LLP, you don't have that. So would you opt for 40% or would you opt for 30%? The net result would be, to do a comparative analysis and then decide on what type of structure you would want to choose for your operations in India. Now coming to the aspects of asset purchase, slum sale or share purchase. Different types of acquisition structures. But, very importantly, what we do in our firm to give complete importance to the tax due diligence report that we request them to provide us. We need to understand what is the tax position of the target company. Does it have carry forward losses? Are there any issues of tax litigation? Is there non-compliance under goods and service tax? Is there a non-compliance under service tax? Are there any issues from customs duty, excise duty perspective? Have withholding tax been correctly withheld and deposited? And, non-withholding on payments made to non-residents, to name a few of these issues which we have seen in due diligence report. Now this adds to my cost. So whether I should go for a share acquisition will depend on my risk appetite of, looking at all these issues. Why should I go for a share acquisition? I would rather do a business transfer. Now assume hypothetically that there is no issue and everything has been agreed with the buyer and the seller and they want to do a share acquisition. Well and good. Certain very important points need to be kept in mind. Who are the parties to the transaction? Non-resident versus non-resident, non-resident versus resident, or whether it is a resident versus resident transaction. Because the tax implications are going to be different for each of the transaction between the concerned parties. Whether this is a listed company, whether this is a private company, and whether I'm going to have a tax withholding obligation, whether I need to do a valuation, whether there is a carry forward of loss if my shareholding exceeds 51%. So the answer to all of this is that there could be a capital gains tax implication in the hands of the seller. It could be long-term capital gains or short-term capital gains. Long-term means listed shares. Long-term means you should hold it at least for 12 months. Unlisted shares, short term, you should hold it at least for 24 months. So in most of the deals that we have seen, I think the shares are going to be held for more than 12 months in the case of listed and more than 24 months in the case of unlisted. So you will have a long-term capital gains tax. It could be 10% or 20%. You have a mechanism of calculating capital gains tax based on the cost inflation index. If you opt for 20%, you get that option of cost inflation index mechanism, which is a process of, enhancing your cost acquisition price. Whereas if you opt for 10%, you don't get that cost inflation. The seller is subject to capital gains tax, but under the tax law, the obligation is cast on the buyer to withhold. And that is where the problem lies. On what should I withhold? Should I withhold it under the tax law or should I look at the tax treaty? What if I'm coming from Mauritius? What if I'm coming from Singapore? Or what if I'm coming from a non-treaty country? If you're coming from a non-treaty country, then obviously the 10% or 20% will apply. But if you're coming through a country like Mauritius or Singapore, then one can look at the treaty and identify you are eligible for a reduced rate of tax withholding. So the important factor here is please do a valuation. The seller has to do a valuation on the shares that he's selling, and it should be at the fair market value determined as per the net asset value method prescribed under the rules. Similarly, for the buyer, the tax law says that if a buyer is going to receive shares, mind you, it doesn't talk about whether the shares are going to be transferred or whether the share is just an issuance. It talks about receipt of shares, which is less than the fair market value. Then the difference between the fair market value and the consideration that you have received will be taxed as income from other sources at the rate of 40%. So the catch is that please do a valuation and please do the tax withholding. And importantly, for the tax withholding, you need certain registrations. You need a permanent account number. You need a tax deduction account number. And assume that I'm going to close my deal somewhere in the month of, say, April 30th. Then I think we are already late. We should have started this process 2 months ago because the PAN permanent account number registration requires you to provide apostille documents. It has to be attested by the Indian embassy, and all this takes time. So if you're going to think about all these registrations at the last moment, it becomes very difficult for the closing to happen within that timeline. So this was about share acquisition. So give me a second. Now, assume that I don't want to do a share purchase because I'm a little doubtful about the tax legacy that are there. What is my other option? My other option would be a slum sale. What is a slum sale? A slum sale is a term recognized under tax law, wherein all your assets and liabilities are bundled together. You don't assign individual values to those assets. And let's say that you have done a net worth calculation for a slum sale, which you're supposed to do. A chartered accountant has to provide a valuation, total assets minus liabilities. This is my net worth consideration. And that is what the seller is going to seek from the buyer. And if the seller has held those assets for more than 36 months, then it will be taxed at the rate of 20%. And even in this case, in a slum sale, what happens is the tax losses which you have, it doesn't get transferred to the buyer. In a slum sale, as Rukshad pointed out, that what you cannot do in a share acquisition, you could do in a slum sale in respect of, carving out certain liabilities, carving out certain assets, and consider doing a slum sale, which is beneficial for the seller. But here also, we would recommend that the foreign party or investor should set up either a private limited company or an LLP, and the transfer of assets and liabilities and employees should be done to that Indian subsidiary. The last one would be, of course, an asset purchase where you cherry pick individual assets. These are the assets I want. And in most of the M&A deals that I have seen in India, it's an asset purchase is seldom done, but it's not that it's not done. Whereas in the US, it's always structured as an asset purchase agreement. So in India, if you do an asset purchase transaction, then there will be a tax liability. The tax liability, depends on whether they are depreciable assets or non-depreciable assets. By depreciable assets, I mean, when you have a depreciation table, at the end of each year, you have a written down value. So if the sales consideration is exceeding my written down value, then the excess will be taxed at whatever rates applicable to those assets and holding period. And if it is less, then whatever is balance would be available for depreciation going forward. So these are the three types of, acquisition structure that we are generally seeing, but you have a tax implication in all these three kinds of situations. If you want to do a new tax neutral transaction, you can consider a merger or a demerger, but that process will be court driven. And it typically takes about at least 9 to 10 months. And given the pandemic, unfortunately, and the backlog of cases, I think it could even go to about 12 to 13 months if you make an application today. So most of the foreign investors to whom we have spoken to are wary about the timelines in respect of going to the court for a approved merger. But that's an option if you want to keep in mind for complete tax neutrality in the hands of the shareholders as well as the company. Moving on, India had wonderful tax treaties with Mauritius and Singapore for the last 20-25 years. And in 2016, the tax treaty was changed. The tax treaty was changed with Mauritius because Mauritius gave you complete capital gains tax exemption. You don't pay taxes in India, you don't pay taxes in Mauritius. The money which goes back from Mauritius to US is also tax exempt. So it was a win-win situation, for majority of the investors. But now things have changed, but there is a promise that any investments that have been made prior to April 1, 2017, that is, if a Mauritius company has acquired certain shares prior to 2017, then those shares are going to be grandfathered. So there won't be any tax on that. But any investments after April 1, 2019 will be subject to the normal rates, which means that you could have a 10%, 20% on long term, you could have 15% on short term, and if it is off market, it could be 20, 30 or 40% depending on the residential status of the parties involved. So to be honest with you, ever since the BEPS project kicked in, ever since we have the OECD and the G20 countries talking about, tax collection, structuring options, intermediary locations, identifying tax-friendly jurisdictions have been a big issue. In the sense that, it's not looked at ethically because people are nowadays talking about even moral tax and not taxes that are levied as per the tax rules. So the options are very limited. You have the general anti-avoidance rules. So what we recommend is that depending on the quantum of investments that you're wanting to make, depending on the amount of expenditure that you are ready to expend to keep a structure commercially viable and creating commercial substance, you need to take a considered opinion on whether that's worth it or should I directly invest from the home country from where I'm coming? For example, if you're having an operating company already in the Netherlands, already in, say, Malta or Ireland or France, if you are a private equity fund, it makes sense. You could consider these structure. You could consider incorporating a company, or if you have an operating company already existing, well and good, because it provides capital gains tax exemption on when you exit the Indian company. Lastly, but just one more point on the tax treaty. Notwithstanding the changes that have been made to the Mauritius structure, in case you are investing in debt instruments, convertible bonds, preference shares, or other type of securities that are not shares per se, Mauritius offers you still 7.5% tax withholding rate. So we can still keep that in mind. Lastly, indirect transfers ever since 2012 have been a pinching point. Vodafone is in the news, Kane Energy is in the news. So to explain it very briefly, what it means is that when you are doing a share acquisition, that is, there is a share acquisition happening between two non-residents outside India. But one of the non-resident has a subsidiary in India. All the assets of the Indian subsidiary is getting transferred. Nothing moves in India, everything moves abroad. That is where the indirect tax provisions, get triggered. So, of course, there are two carve-outs in this. One is that if the total assets of the Indian company are less than 10 crore, and if the foreign company's assets represents less than 50% of all the assets that it owns outside India, then the substantial condition criteria does not get triggered and the indirect transfer provision do not get triggered. For these, there are detailed valuations which run to about 20 pages that have been issued by the Central Board of Direct Taxes. You need to have a valuation at the India level. You need to have a valuation at the US level or any other country level. Then you need to have a comparison of both and then identify whether it meets the 50% threshold value or the 10 crore value, and then decide what my position is. So even under an indirect transfer, the tax due diligence becomes very important. If it throws up that the Indian company is having issues, legal tax legacy issues, then you should go for a tax insurance. You should go for tax indemnity, or otherwise, things may become quite litigative at the end of 2 or 3 years. So with this, I complete my tax considerations. Thank you.
Thanks, Rukshad and Ravi, for your helpful insights on investments into India. Moving on, we have received a few questions from our audience, which I would request you to answer. Rukshad, you spoke about the widely discussed Press Note 3. Has the introduction of this press note impacted FDI inflows in the last year? And also, have any FDI proposals seeking approval under Press Note 3 been cleared by the Indian government as yet?
Sure. So the Indian government has not cleared any proposals in respect of Press Note 3 of 2020. And to answer the first part of the question, I mean, there has been a dip in terms of investments from China as well as Hong Kong and Taiwan, what we used to see it being forthcoming. So those have dipped by virtue of this new press note coming into being. However, we have heard that the government is now going to take up proposals involving Press Note 3. And as I mentioned in the course of my presentation, that once the government takes up these proposals and once they grant approvals or they do not grant, and they specify reasons for not granting these approvals, we will know the government's mindset in respect of dealing with these with this press note 3 of 2020, and that will provide some clarity on the way forward if the government does not clarify in letter and print of the law as to what would be the beneficial ownership norms and the trigger requirements for applying under this press note for approval.
Sure. Thanks, Rukshad. You also touched upon different transaction structures that are typically adopted for M&A transactions in India. Now, from a timing and cost standpoint, which transaction structure is more efficient? Is it an asset purchase, share purchase, or a slum sale?
So I would say that from a timing and a cost perspective, the share purchase would be from a timing and a cost perspective, that share purchase would work best. From a timing and a cost perspective, an asset purchase or a slump sale will not work. I mean, given the fact that there will be novation of contracts, assignment of leases, and all of the sorts. When you are going in for a slump sale or an asset transfer, and also there will be a lot of cost implications in respect of what I mentioned was GST as well as stamp duty. Those are certain cost implications that would weigh in on a share, on a slump sale or a business transfer, and on an asset transfer as compared to a share purchase. So from a timing and a cost perspective, a share purchase would work the best.
Sure. On a related note, Ravi mentioned that mergers and demergers are a tax efficient option for undertaking M&A transactions. Do you feel that from a corporate law standpoint, these modes are a good option for undertaking third-party M&A transactions?
Sure. So I think given the timelines involved and the court process and the NCLT process that would run for a demerger or a merger, because these are all governed by and administered by the National Company Law Tribunal. So from that perspective, I think it will not work. I mean, the best way would be to either do a share purchase or a slump sale, business transfer, or an asset buyout, as compared to a merger or a demerger. From a tax neutrality standpoint, and only if that is the consideration, then it makes sense to wait for this approval and to go down the merger or a demerger route. And of course, even if we go down the merger or a demerger route, I think there are very stringent conditions that need to be complied with and that need to be fulfilled if you are going in on that route. So you really need to be very mindful about ticking all the boxes appropriately, so that you file the scheme, you go ahead with the NCLT, and finally you don't get the tax neutrality or the tax break by the tax authorities. So you need to be very careful, and you need to be really very sure that you are going to tick all the tax boxes and fulfill all the tax requirements to get a tax neutrality status in case of a merger or a demerger.
Sure, thanks, Rukshad. Ravi, a question for you on the India-Mauritius Treaty. What would be the Indian tax implications if a Mauritius entity has acquired shares of an Indian company prior to April 1st, 2017, and those shares are being sold in 2021?
Well, the answer is that a promise had been made by the finance minister that investments made prior to April 1, 2017 will not be taxed in India. The tax treaty will be, will be regarded. But as we all know, tax deficit, tax collections, as well as the aggressive nature of the Indian tax authorities, such promises can be broken as long as the Mauritius company is able to, prove that I am not a shell company. I have expenditure worth more than 27 lakhs in the previous years for each year of my existence in Mauritius. I have a bank account. I am filing my tax return. I am having a bank account through which the money flows. I have directors in Mauritius who are taking decisions. It's not that a US or a German guy is taking the call in Mauritius, is just acting as if it's a conduit. So to answer that question, the answer is that if you have your documents, if you can prove it, you can still expect litigation at the lower levels of tax authorities. You can expect some amount of relief at the tribunal level. So there will be considerable litigation because, people are not, the tax authorities are not going to give it to you on a platter that this is grandfathered and everything is good to go. We know what's happening in Kane. We know what's happening in Vodafone. I don't know what's going to happen in Sanofi. I don't know what's going to happen in Cadbury. So all these are still pending and, the answer is be ready for litigation. But if you look at the fine print, it should not be taxable, but that's not the way it works.
Sure, thanks, Ravi. Another question for you on the slum sale. Can I do a slump exchange instead of a slum sale and still claim the tax exemption?
I think that's a very good query, but that's what majority of the people have been, thinking about in the last 2 or 3 years. And tribunals and one Delhi High Court have even, approved. So that question is really an intelligent question, and the courts have held that yes, if there is no sale, in the sense, sorry, in the case of an